What's going on, everybody? My name's Tom Homan Jr., and I'm the owner of Homan Realty Group. And we're joined today with Justin Kelly, the owner and CEO of CPF Mortgage. And we know that there's been a lot of hysteria out there, a lot of questions regarding interest rates in the mortgage industry right now, and what the feds have done recently, and how does that really affect us? And we're hoping that, Justin, we know for a fact you can actually speak to that. So take it away.
Yeah, thanks, TJ. The most recent news is obviously, the Fed yesterday lowered the Fed funds rate by 0.5%. And this has caused a whole lot of sensationalism, confusion for people. And I'm seeing a lot of things on social media, unfortunately online, that just have misinformation and or confusion wrapped around what does this mean? Because the Fed lowering interest rates yesterday by 0.5% does not equate to 0.5% in lower mortgage rates. They're not the same thing. So the first thing we need to do is identify what the Fed funds rate is and what mortgage rates are. And I think if we do that, we can explain then how they are actually correlated. So let's start with the Fed funds rate. This is a tool that the Federal Reserve uses to battle inflation. Now, we know in America in the last few years, we've had a lot of spending, there's been a lot of money flowing, and that has caused inflation to get out of control. And everybody sees it when you go to the grocery store, recently, when you've gone to buy a car. Pretty much every aspect of our life, we've seen prices increase. That is inflation. And when we have out of control spending, the Fed uses that rate, that Fed funds rate, and they increase it. And what that does is it increases the rate to borrow money on short-term duration loans. These include things like credit cards, car loans, boat loans, all of the toys that people spend money on. And so the thought is, and the hope is, and this is what the tool is for, is that by raising the cost to borrow, it quills and stops the spending, and then inflation comes down. Okay. So that's what the Fed funds rate is, and that's what it affects. Mortgage rates are tied to long-term durations or mortgages, and they're driven by the bond market. So that's the difference between the two. Now, what drives both of them? Inflation. Okay. So the Fed uses the Fed funds rate to battle inflation by raising that rate when they need to drive prices down. In the same respect, the mortgage market reacts instantly to inflationary pressures. And so we work much like the stock market. We're thinking what's going on now and what's happening ahead. And mortgage rates are priced based on inflation now. So as we started in the mortgage industry, started to see, talk a couple of months ago from the Fed that, hey, we think we're starting to get inflation under control. Well, you saw, and everybody's seen, the mortgage rates started coming down as much as 8 weeks ago. So we've already priced all of this stuff in the mortgage rates. Okay. So what the Fed did yesterday really had nothing to do with mortgage rates. Actually, we had a slight bump in rate yesterday. It actually increased just a hair. So the common denominator between Fed funds rate and mortgage rates is inflation. And it's driven the Fed and mortgage rates to react to that. It's important to note that the Fed uses trailing data or old data. They're looking 3 and 6 months back to make decisions on the Fed funds rate. The mortgage market doesn't look back. We're looking at what's happening currently right now. And that's why the mortgage market and rates started coming down before this decision ever happened. And so that's the confusion that people are getting. They're thinking that the Fed funds rate is mortgage rates, and that just couldn't be further from the truth. The only way that they are correlated is through inflation.
Yeah, because Justin, I'm seeing there's a lot of lenders out there saying interest rates, just got cut by 0.5%. And I think it's causing a lot of confusion with the average consumer right now. Because, we had a flood of phone calls this morning about that.
Yeah, we've had a flood of phone calls just from borrowers and just people in general, just not understanding it and thinking, oh, this must affect mortgage rates right now. So they just got dropped 0.5%. So, is my rate going to be 0.5% lower now? And unfortunately, yes, you see a lot of uneducated people out there talking on this subject that don't really understand the intricacies of how these things work. And so that's why it's really important to find an expert, somebody who really truly understands the fundamentals of the market when it comes to these rates and what it means for you as a consumer.
Yeah, and thank you. That's why I felt it was important. That's why I sent you a message late last night to see if we can get your insight on this, because I know you have the background in this. You hold some high position seats in some of the biggest wholesalers out here in the industry. So I figured to hear directly from you, it could definitely help, especially my peers and your peers in our
Yeah.
industry, to be able to educate all of our clients, buyers, consumers, going forward. The one big question that I've been asked between last night and this morning is, so if rates are not coming down 0.5% today, like everybody was hoping, and like they're saying out there on social, what does it look like in the coming months? Do we have an idea, some sort of projection?
Yeah, I mean, listen, all I will say is I hate making predictions, but it
Yeah.
looks like we are in a declining rate market. Now, this is going to be very closely watched. And what you want to watch and what you want to listen to as a consumer is inflation. Because if we continue to see inflationary pressures come down, you will continue to see mortgage rates react immediately to that news. We won't wait for the Fed and the next rate cut. It will already take place by the time they make that rate cut.
Okay, so that makes a lot of sense. And it's definitely, rates are not coming down 0.5% today. So we just want to make sure folks understand that.
No, unfortunately not. But we have seen rates come down considerably in the
Yeah,
last couple of months.
yeah.
Don't get me wrong, but just understand that it's because the mortgage market saw this coming. They saw that the Fed is getting inflation under control. And so we're going to react immediately to that. We're not waiting for the Fed to make a decision on the Fed funds rate. We're making decisions based on long term duration rates, mortgage loan rates, and we're doing it instantly.
Sure. And Justin, we're going to drop this video to all of our followers today. What is another way that they can contact you directly? Should they have any questions?
Yeah, absolutely. I mean, please do reach out to me. I'm on social media. I'm very easily, reachable. You can call my office as well at 727-226-1040 anytime. My email is justin at cpfloans.com. You can also go to our website and post a question and submit something into us if you'd rather communicate, that way. There's no shortage these days of finding us or ability to contact us, and I'll hop on the phone with anybody that has questions. No problem.
Excellent. Well, Justin, thank you for jumping on today and clarifying this. And we're going to get this video out there to help educate our peers and consumers alike. So thank you very much for your time.
Yeah, I really appreciate you bringing me on. You're always a leader in your industry and ahead of things. I got the call from you, yesterday when this happened, and you were just right on top of it, really wanting to understand what's going on before you put information out. You wanted to know the facts, and I commend you for that.
Thank you. And if anybody wants to reach out to me directly, you can do so by sending me a text or calling me at 352-585-5205, or you can email me at tj@thehomengroup.com. Thank you again, Justin, and we look forward to talking to you in the next days to come.
Awesome. Have a great day.
You too.